Using expiration dates that align with the investor's market outlook and risk tolerance. Monitoring the stock price and being aware of assignment risk on the call, especially if the stock price approaches or exceeds the call's strike price. Understanding the trade-offs between the cost of downside protection and the cap on potential gains. A collar strategy in stock investing is a conservative approach that balances downside protection with capped upside potential. It is particularly suitable for investors who are willing to forego some profit potential in exchange for reduced risk and greater peace of mind in uncertain or moderately bullish market conditions. Using the credit spread to speculate in stock markets. This involves selling an option, put or call, and buying a further out-of-the-money option of the same type. It generates income from the premium received, but has limited profit potential. What is the objective of using a credit spread in stock options trading? The objective of using a credit spread in stock options trading is generating income from option premiums with limited risk. This strategy involves simultaneously selling one option and buying another option of the same type, either calls or puts, but with a different strike price, resulting in a net credit to the trader's account. The primary goal of a credit spread strategy is to generate income through the premiums received from selling options. This involves selling either a put or a call option and buying a further out-of-the-money option of the same type, such as a put or call. The strategy is designed to capitalize on the premium differential between the sold and bought options, primarily focusing on income generation rather than capital appreciation. How does the credit spread strategy fare across various market conditions? The credit spread strategy can be effective in various market conditions depending on the type of spread used. A bull credit spread, which entails selling a lower strike call and buying a higher strike call, works well in rising markets, whereas a bear credit spread, which involves selling a higher strike put and buying a lower strike put, is suitable for declining markets. Credit spreads can be adapted to various market conditions. A call credit spread or a bear call spread is typically used in bearish or neutral market conditions, while a put credit spread or a bull put spread is effective in bullish or neutral conditions. The strategy is particularly useful in markets where the underlying asset is not expected to exhibit significant volatility beyond the strike prices of the options involved. What risks are involved in a credit spread strategy? The risks involved in a credit spread strategy include a limited maximum loss and profit potential. The maximum loss is the difference between the strike prices of the two options minus the net credit received, and the maximum profit is the initial credit received. The trader's risk is capped, but so is their profit potential. The risk in a credit spread is limited to the difference between the strike prices of the options minus the net premium received. This defines the maximum loss, which occurs if the market moves significantly against the position. However, the potential profit is also capped at the premium received for setting up the spread. What rewards can be expected from a credit spread? The rewards from a credit spread include income from premiums with capped gains. The trader earns the net premium received from setting up the spread, which is the maximum profit. This strategy aims to benefit from the time decay of options and the underlying asset's price movement in a favorable direction. The reward potential with a credit spread is the net premium received from the difference between the premiums of the sold and bought options. The best case scenario is where the underlying asset's price stays favorable relative to the strike prices, allowing the options to expire worthless, and the trader retains the full premium. However, the gains are limited to the initial premium received. What key steps should be considered when implementing a credit spread in stock options? Key steps in implementing a credit spread include choosing the right strike prices and expiration dates for both the sold and bought options, assessing market conditions to decide whether a bull or bear spread is more appropriate, and managing the trade to maximize the probability of keeping the premium received. Monitoring the underlying asset's price and being prepared to adjust the position as necessary are also important. To implement a credit spread strategy effectively, determine the market outlook to choose between a call or put credit spread. Select the appropriate strike prices for both the sold and bought options, ensuring the sold option is closer to the current market price. Choose options with the same expiration date to create the spread. Calculate the net premium received, which is the income from selling the spread, and understand the maximum potential loss and gain. Monitor the underlying asset's price movement and be prepared to manage the position, especially if the market moves towards the sold option's strike price. Be aware of assignment risk, particularly for the sold option as expiration approaches. A credit spread strategy in options trading requires careful selection of strike prices and a clear understanding of market direction. It offers a balance between income generation and risk management, making it a popular choice for traders seeking to profit from premium decay in a controlled risk environment.